Hello and welcome to another weekly financial update from RTS Financial Planning. As always, I'm your host, Chartered Financial Planner Carl Roberts. And this is where we go through some of the stories that have happened in the world of finance over the last week and also discuss some of the subjects that our investment committee are looking at as part of our RTS investment strategy. So, stock markets around the world this week were pretty flat. They've had a pretty flat performance over the last week, with the UK fearing worst, and this was mainly as a result of new lockdown fears. So there was a lot of talk in the UK this week from the government around what sort of measures are coming next to try and drive cases numbers down. Data out at the end of last week showed that the UK economy grew much less than expected during August. I remember August was the month of the Eat Out to Help Out scheme, which cost the UK government 500 million. It was also the month with probably the least amount of restrictions in terms of being able to go out. So really, growth should have been much higher. What's worrying though is if this was the growth rate when things were more open, what's going to happen the next few months as lockdown restrictions come in and our lives are disrupted once again? Interestingly, it was reported this week that the Bank of England had asked banks about their readiness for negative interest rates. Now, it's been rumoured for a while that the Bank of England are considering negative interest rates to help kickstart the economy. So does this mean that you could soon find that your bank is offering you negative interest rates and therefore charging you to save cash with it? Possibly, possibly not. Interest rates are already low amongst high street banks, and the bank base rate is already 0.1%. Many banks out there are offering savings rates at 0.01%. So does it really matter if that rate goes a little bit lower? Probably not. The banks also know that if they lower rates too much, there's always a possibility that you can take your cash out of the bank and just store it at home. But I'm not sure how many people would be comfortable with large amounts of cash stored at their house. Some banks do still offer savings accounts with interest rates closer to 1%. And I think if interest rates do go negative, you'll still find some banks out there offering positive rates. It will just be a case of shopping around. The main aim of negative interest rates is to charge commercial banks for storing cash with the Central Bank of England. It aims to encourage those banks to, rather than hoard the cash, release it into the wider economy through loans to businesses and consumers. The problem is that many businesses right now look at the uncertainty and probably don't want to take on any more debt or loans. So they're waiting to see what's going to happen. This could mean that the money ends up in the housing market through mortgages, which is not what the Bank of England want. It could also end up propping up share prices if companies take on cheap debt to then buy back shares and help boost their share price. Economists are divided as to whether negative interest rates actually work, and therefore it's still not entirely clear whether the Bank of England will use this tactic. It's not all doom and gloom though. There are certain sectors of the economy that are still thriving, mainly online businesses, online services like streaming services, takeaway businesses and online fashion retailers. They're all reporting strong sales and rising share prices. It's important to know which sector works best in different economic environments. So that wraps up another update. I hope you found it useful. We will be doing some more videos and some more detailed content on negative interest rates, just in case this does come about. So do remember to subscribe to the YouTube channel so you don't miss out on the latest videos around this. Until next time, take care.